You buy a hotel, rooms fill themselves, guests pay up front, and the building appreciates while you sleep. That is the pitch. Here is the number that breaks it. Extended stay hotels. Once America's largest extended stay chain, with 680 properties, filed for bankruptcy in June 2009, carrying $7.6 billion in debt against $7.1 billion in assets. The equity holders who bought in at the peak got $0 back. Here is what this actually costs. A 120-room, limited-service branded hotel is the entry point most owners actually buy, not a resort. According to HVS's 2025 U.S. Hotel Development Cost Survey, the median development cost for limited-service properties runs close to $167,000 per key. For 120 rooms, that is $20,040,000 before you have sold a single night. Land alone typically consumes 9% to 14% of that budget, so call it $2.2 to $2.8 million just for dirt, before pouring a foundation. Hard construction costs, the actual building, run the largest single line, and urban sites can add another $50,000 to $200,000 per key in land premium alone, before a foundation is poured. Soft costs stack on top: architecture, engineering, permitting, insurance during construction, and legal fees, which routinely add another 6 figures before opening day. FF&E, the furniture, fixtures, and equipment that make a room sellable, typically runs 8% to 15% of total project cost. On a $20 million build, that is $1.6 to $3 million just for beds, HVAC units, and lobby furniture. Then add OS&E, the operating supplies and equipment, linens, dishware, cleaning stock, that must exist on day one before a single reservation is confirmed, plus a contingency line most experienced developers refuse to skip, because construction budgets in this sector routinely move once permitting starts. Then comes the cost nobody puts in the pitch deck: the franchise property improvement plan. If you buy an older property and convert it to a current brand flag, the brand doesn't just take your application fee. A recent case documented by Terrapin Construction Group showed a 132-key conversion priced at $58,000 per key for a full interior gut, or $61,500 per key once a mandated sprinkler upgrade hit permitting. That is not a rounding error. That is $8.1 million the brand can force on you, because a 28-year-old plumbing riser doesn't meet spec. Add the initial franchise application fee, typically $30,000 to $100,000, and total entry cost on a modest 120-room hotel lands between $22 million and $28 million before a single guest checks in. Now the money that leaves every single month, whether rooms sell or not. Property taxes come first, assessed on the full appraised value of the building, not on what it earns, and they do not pause during a slow quarter. Insurance is next, and it has stopped behaving like a fixed cost. According to Hotel Management and CoStar, reporting from 2025, most hospitality operators saw premium increases of 5% to 15% over the prior 12 to 18 months. But operators in coastal or catastrophe-exposed markets reported jumps of 25% to 50%, with some carriers withdrawing from the hospitality segment entirely. Franchise fees run continuously, calculated as a percentage of room revenue whether the brand did anything to earn it that month or not. According to HVS's franchise fee guide, royalty fees typically run 4% to 6% of room revenue. Marketing and reservation contributions add another 1% to 5%, and loyalty program fees add roughly 1.7% more. Combined, HVS's research puts total franchise-related costs at an average of 10.8% of room revenue across a 10-year horizon. On a hotel generating $4.5 million a year in room revenue, that is roughly $486,000 gone to the brand alone, every year, forever. Then there is distribution. Every room booked through Booking.com or Expedia costs a commission, and according to multiple 2026 industry sources, Booking.com typically charges 10 to 25%, averaging around 15%, while Expedia runs 18 to 22%, climbing past 25% with preferred placement programs. If even a third of your rooms book through OTAs, that channel alone can eat $150,000 to $250,000 a year on a hotel this size. Payroll comes next, and unlike a retail store, a hotel cannot close for the night. Front desk, housekeeping, and maintenance staff exist because the building runs on a 24-hour cycle, whether 3 rooms sell or 90. Utilities run continuously for the same reason, heating and cooling occupied and vacant rooms alike, since a guest expects a cool room the moment they check in, not 20 minutes later. A capital reserve for replacing carpets, mattresses, and roofs typically runs 3% to 5% of total revenue, set aside every year whether it gets spent or not, because the franchise agreement requires the property to stay at brand standard on inspection day. If the hotel uses a third-party management company instead of self-managing, add a base management fee, commonly 2% to 4% of total revenue, on top of everything else already listed. Add it up: franchise fees, insurance, taxes, distribution costs, payroll, utilities, capital reserves, and management fees. And a modestly sized branded hotel routinely spends $3.2 to $3.6 million a year before it has earned a dollar of profit. Now, the revenue side, at real market conditions, not best case. According to CoStar's mid-2026 data, the national average daily rate sits near $165 to $174, and national occupancy runs in the 62% to 69% range depending on the month. Run 120 rooms at 365 nights, that is 43,800 available room nights a year. At 63% occupancy, that is 27,594 nights sold. At a $165 average rate, that is $4,553,000 room revenue. Subtract the $3.2 to $3.6 million operating cost stack, and net operating income lands somewhere between $950,000 and $1.35 million before debt service. On a $22 to $28 million asset, financed the way most hotels are financed, that margin gets consumed almost entirely by the mortgage payment. The real net margin after debt on a leveraged hotel purchase frequently lands in the low single digits. That is not a rounding error. That is the entire business. But the number on the page assumes a stable world. It rarely stays stable. The one variable that destroys hotel margins faster than any other is credit availability, and it has done it before. Through 2007, hotel valuations peaked on cheap, aggressive financing, with lenders competing to underwrite deals at multiples that assumed occupancy and rate would keep climbing indefinitely. When the credit market seized in 2008, occupancy and rate both fell at once, a combination hotel underwriting rarely stress tests for, because most models treat the two as independent variables that move separately, not as a single collapse. Extended Stay's own RevPAR fell 23.2% in a single year, according to bankruptcy filings reported by NBC News. A hotel does not need to lose half its rooms to collapse. It needs its RevPAR to fall by a quarter, while its debt payment stays exactly the same. And 2025 already produced the first non-recessionary full-year RevPAR decline ever recorded in the U.S. hotel industry, according to STR. A reminder that this variable does not require a recession to bite. Which brings us to the company that lived this collapse at full scale. Extended Stay Hotels was not a small operator. At its peak, it ran 680 properties across 44 states and 2 Canadian provinces, generating roughly $1 billion a year in revenue. one of the largest hospitality platforms in the country. In June 2007, the Lightstone Group, a real estate investor with no prior hotel operating experience, acquired Extended Stay from the Blackstone Group for approximately $8 billion, financing the deal with roughly $7.4 billion in debt against a business generating around $1 billion a year in revenue. That debt load assumed the good times would continue. They did not. As the 2008 recession hit business travel, the segment Extended Stay depended on most, since its guests average 18 to 20 nights per stay, compared to 2 or 3 nights at a typical hotel. Occupancy and rate both cracked simultaneously. A court-appointed examiner later spent months investigating the collapse and found that a significant amount of property-level expenses had been misclassified during the acquisition's due diligence, meaning the buyer never fully understood what they were servicing in the first place. By December 31, 2008, the company carried $7.6 billion in liabilities against $7.1 billion in assets, a business technically insolvent before the recession had even finished playing out. On June 15, 2009, Extended Stay filed Chapter 11, one of the largest commercial real estate bankruptcies in U.S. history at that point, listing 680 properties across 44 states and 2 Canadian provinces, and roughly 10,000 employees whose jobs depended on the outcome. When the company finally emerged in October 2010, sold to a Centerbridge, Paulson, and Blackstone consortium for $3.925 billion. Existing equity received nothing. Zero. This was not one bad manager running a front desk. Every property kept operating through the entire bankruptcy. Guests kept checking in. Housekeeping kept cleaning rooms. This was a capital structure, built for a world that stopped existing. And the industry has repeated some version of this cycle in nearly every downturn since. There is a cost that never appears on a projected income statement, and it eats real transactions every single day. The OTA commission stack combined with payment processing. Picture a $200 a night room booked through an OTA charging an 18% commission. That is $36 gone before the guest even checks in. Add roughly 3% in payment processing and chargeback exposure, another $6. On paper, that room sold. In reality, the hotel just banked $158 to cover housekeeping, utilities, franchise fees, debt service, and staff wages on a room that looked like full-price revenue in the booking report. There is another cost, growing faster than any other line item on a hotel's books. And it is not labor. That cost is insurance and litigation exposure, and it is compounding. Beyond the 25% to 50% premium spikes already hitting coastal and catastrophe-exposed hotels, general liability costs are rising separately, driven by what the insurance industry calls nuclear verdicts. Industry tracking cited by hospitality insurance broker the Sohi Group found 135 nuclear verdicts against companies in 2024 alone, a 52% year-over-year increase, totaling $31.3 billion in jury awards. A hotel does not need a hurricane to lose everything. One premises liability lawsuit, one jury verdict in a sympathetic venue, can exceed a small hotel's entire equity position in a single afternoon in court. Scale changes what breaks and what heals. At larger portfolio size, procurement gets cheaper. Franchise companies negotiate better reservation fee terms. Insurance carriers offer more favorable layered coverage, and a bad quarter at one property gets absorbed by strong quarters elsewhere. That is the part every acquisition pitch leads with. But scale also means every brand-mandated capital refresh. The guest room technology upgrades pushed across 2024 and 2025 prototype standards alone added $1,800 to $3,200 per key, according to Terrapin Construction Group, and every regulatory or insurance shift now applies across dozens or hundreds of rooms simultaneously, instead of just 12. A single franchise-wide technology mandate across a 40-property portfolio at the low end of that range is $8.6 million, due on the brand's timeline, not the owner's cash flow cycle. At a certain size, hotel ownership stops being a real estate business and becomes a leveraged, brand compliance business with a real estate wrapper, and the owner's real job shifts from filling rooms to managing covenant compliance across a debt stack. Now, two honest scenarios, side by side, on our same 120-room hotel. Optimistic, occupancy holds at 69%, the top of the current national range. Average rate reaches $178. Insurance renews flat. The OTA mix stays under a third of bookings, and no litigation or major capital call hits during the year. Room revenue lands near $5.8 million. After the operating cost stack, net operating income before debt service reaches roughly $1.6 million. After debt service on a $24 million loan at a market rate, net profit lands somewhere around $500,000 to $650,000 a year, a genuinely attractive return on the equity actually invested. Realistic, occupancy drifts to a more typical 62%. One franchise-mandated PIP renovation hits mid-cycle at $2.5 million because a brand technology refresh became mandatory. Insurance renews up 20% instead of flat, adding roughly $80,000, and a single slip-and-fall lawsuit settles for $250,000 after legal fees, an amount well within the range of the nuclear verdict trend already documented. Recalculate, and that same hotel's annual profit doesn't just shrink. It goes negative for the year the renovation and settlement land. Even though every room was cleaned, every guest was checked in, and nothing about daily operations changed. The difference between those two scenarios is one capital improvement cycle, one insurance renewal, and one lawsuit. None of these are exotic disasters. All three happen to someone in this industry every week. According to Bureau of Labor Statistics data, roughly 20.4% of all new businesses fail within their first year, and nearly half fail within 5. Hospitality-adjacent operators, hotels included, sit on the harder end of that range because the business combines heavy fixed debt service with a perishable product. A room unsold tonight generates zero revenue forever. No discount tomorrow can recover it. The primary cause of failure is almost never bad service, a rude front desk clerk, or a dirty lobby. It is almost always structural. Too much leverage at acquisition, insufficient cash reserves for a bad quarter, and franchise obligations that don't flex when revenue does, because the royalty fee is still due whether the hotel is full or half empty. The operators who survive share 5 concrete habits, and none of them are about hospitality skill. They hold 6 to 12 months of full operating expenses in reserve, not just enough to cover debt service. They underwrite purchases assuming a downside RevPAR scenario from the start, not the trailing 12-month number the seller hands them. They negotiate franchise agreements with fee caps and PIP cost ceilings written into the contract before signing, not after. They diversify booking channels deliberately, so no single OTA controls more than a third of total revenue, and they budget for the next PIP cycle and the next insurance renewal a year in advance, instead of treating either as a surprise when the notice arrives. A hotel still looks, from the lobby, like the simple dream. Rooms fill themselves, guests pay up front. But behind that lobby sits a $22 million capital structure, a franchise fee that takes 10.8% of revenue no matter what, and a debt payment that does not care what the weather did last quarter. Extended stay proved that even 680 properties and $1 billion in annual revenue can't outrun a bad capital structure. The real business of owning a hotel chain is not hospitality, it is leverage, wrapped in a lobby. If you want the next breakdown before it hits your feed, subscribe.